Investors make the smartest decisions with real data. Stay tuned. Well, thanks so much for joining us for this week's edition of Note School TV, where every week we bring you the most amazing guests as well as the most amazing content. So today is no different. We have an amazing guest today, and we will introduce you to him in 2 minutes, right? So before we do that, first thing, make sure and hey, like this episode for us. Yeah, just hit that like button. Make sure to, or that you have already, if you haven't already done so, make sure and hit that subscribe button as well, and hit that bell notification. Boom, go ahead and hit it so that you will have advance notice when we go live. When? Every week at 11:05 Central Time on Wednesdays. 11:05 Central Time Wednesdays. So with that, make sure and please go ahead and continue to send in your comments. Guys, means a lot to Eddie and I as we see those comments. So please keep them coming in. Just type something in short, what the episode meant to you, the guest, the content, all of that. Please make sure and do that. And if you would like to know more about what we do at Note School TV, simply go to noteschool.com/TV. Again, noteschool.com/TV. We'd love to have you in one of our master classes real soon. And just remember our motto at Note School TV and at Note School is we show you how to close more deals. So with that, I am going to bring on Note School's founder, our fearless leader, Chief Visionary Officer, Mr. Eddie Speed.
Good morning, Joe. How are you?
Man, I am really good and super excited that, we have a great guest today, and pretty kind of a big shot, right?
Yeah, he's been about on every news channel out there.
Yeah.
Really an expert in the field of mortgage data and lending data. And so, man, this is a great episode. If this is your first time to see Note School TV and you're watching this, Joe, they're all this good.
Yeah.
Okay.
Absolutely.
No, this is special today because we have a great guest with a huge amount of information, and we're not going to try to manage the time on this show. We're just going to let him go till he's done, right? Because I can tell you right now that everything he has to say, I'm leaned in, Joe's leaned in, we're listening. So Joe, I'm gonna get him on, and we are going to get after it.
Sounds good. I'll see you guys towards the end of the show. Eddie, you and Daren knock it out of the park.
All right. Our guest today is a vice president and does the data analytics. And I don't know if he's the only one involved, but he's a guy that has been my relationship for a long time for auction.com. And I think he'll probably give us the stats. Auction.com is such a significant player in the foreclosure world. I think they do literally about half of the residential foreclosures in the United States. The data that he has is the best data out there as far as what is going on in this marketplace. You guys welcome Mr. Daren Blomquist.
Thanks so much, Eddie. Good morning.
How are you?
I'm doing great. Thank you for that very warm, kind introduction.
Well, I'm honored.
It's great to be here.
Industry friend. You and I have spent a lot of time together. You've even been a keynote speaker at our Note Expo in the past, and thank you for that. And Joe and I you're our go-to when we're saying something and we want to know if it's really the truth. I mean, that we're really saying it and reading it accurately. You're the guy that we trust to keep us straight, and I appreciate that. So I want to give Daren credit. A lot of times when you guys see Joe and I put information up there and stuff, it's sort of what Daren has taught us, that what matters the most. And so we always appreciate your helping us in that regard. Daren, I said this, you've been a spokesman on virtually every news channel out there about this subject over the last 10 years.
Yeah.
And
that's been through the last cycle, which is now yeah, over 10 years ago. And definitely the press, when it bleeds, it leads for the press. So there was a lot of media interested in the data back then. But yeah, happy to be there, and I admire what you guys are doing. And Eddie, it's honor to call you a friend over the years, and I know I can go to you when I need information, especially on the MPL, the notes market. You are my go-to for that. So appreciate that.
Well, it's been a good relationship. We tease you offline. We call you Tom Brady. You know that, right?
Yeah, I heard a mention of that, but I'll take that.
Yeah.
I don't know. Tom is he's aging well, so
He is. Well, you're aging well too. You and him about the same age, right?
Yeah. I think we're right there. I won't get more specific than that, but we're with.
He might be the greatest quarterback to ever be in the NFL, and you might be the greatest data guy out there. How about that?
There you go.
Yeah. All right, Daren, you got a slide with a lot of things. I don't want to manage the time here. I want you to manage it. I want to make sure that you present it in a fashion that lets you present it the best. And if we run over a little bit of our normal stuff, that's okay, because this audience wants to hear what you have to say. So you can bring your slides up and let's roll.
Okay, let's do it.
All right, got them up.
Right. So we're going to start with, and Eddie, I would love if you do have questions or you want to point in a certain direction, dive deeper into any of this stuff, feel free to jump in, which I know that you will.
Yes, sir.
But I'm going to start just to give a roadmap of where I'm going. I'm going to start with some of the macroeconomic housing market landscape. Then we're going to dive a little bit more into the distressed market landscape, and then eventually kind of the tip of the spear for us at auction.com is the properties going to foreclosure. And I know that a lot of your students are looking at a kind of a corollary to that, which is these distressed loans can go down different streams. And one stream is to go into that foreclosure, which is where they end up on auction.com, but also go into the non-performing loan sales. So that's where we're going, and kind of ending on what we're seeing kind of real time in our data in terms of what's happening. Even in January, we saw a shift in some of the things happening. So we'll get to that eventually, but I'm going to start here with the macro market and move fairly quickly, hopefully, through this. But to keep it simple, for our executives here at auction.com and others that I present to, kind of have a dashboard of where are we when it comes to the housing market and the distress market specifically. And I'm sorry, I started on the wrong slide here. Here's the recession indicators that we look at. There's the yield curve, which I'll talk about in a second, which is flashing red right now in terms of recession. Manufacturing, it's flashing yellow. It's not quite in the high danger zone, but it's there. Consumer sentiment, which often is a leading indicator of a recession, has come down quite a bit. You see the reading there in December, below 60. A year ago, it was above 70 from the University of Michigan. Unemployment rate is definitely the bright spot amongst all of these 5 indicators. And then we throw in foreclosure starts here too, even though that's not really a macroeconomic recession indicator, but we look at it carefully for our business, of course. And that number in January was, I looked at the trailing 3-month average here to kind of smooth out the numbers, but you can see with that January 2023 versus a year ago has more than, or basically doubled from a year ago in terms of the foreclosure starts. Although those 21,000 foreclosure starts in January were, and I'll use my little highlighter that you taught me about, focus in on that. Those 21,000, it's still about 80% of pre-pandemic levels. So even though we're doubling from a year ago, from January 2022, we still haven't gotten back to 2019 levels. The job market is what a lot of people will point to as, we could really have a soft landing here. We could avoid a recession because unemployment is so strong. My argument is these strong unemployment numbers, and especially the wage numbers, are going to push the Fed to continue to be fairly aggressive on raising rates, not with the goal of creating a recession, but with the goal of cooling down this very heated, I would say overheated jobs market. And so in a sense, this is actually a bad, the really hot jobs market is a bad sign that the Fed is going to continue raising their rates, their federal funds rate, in an effort to cool down the economy, slow wage growth. And so I would say, on this front, things are not looking great in the long term. And one theme I'll talk about too is long-term versus short-term. These are more long-term indicators. These are more indicators about what may happen, at least when it comes to properties coming to foreclosure. This is talking about 2024 and beyond, as opposed to the short term. But I will talk about some of the more short-term things that we're looking at in terms of volume as well, which I know that Eddie, you're seeing a lot of those indicators in your data as well. And then this is just some indicators we look at in terms of specifically the distressed housing market. These are metrics that we see are highly correlated to foreclosure volume. Of course, unemployment rate, again, which we've already talked about. Home price appreciation, that is flashing yellow. A year ago, we were at 16% home price appreciation. Now we're at 1.6% as of December. And this is according to Adam Data Solutions data, Mortgage Bankers Association data. Seriously, delinquent rate is still very positive, very, very good. But I'll talk about it in a second, a little bit here. There's some early indicators of delinquencies, early stage delinquencies starting to rise. Real estate net worth, that's basically home equity. And a lot of people point to home equity as, this is also going to be the savior. This is also going to create a soft landing for the housing market because people have so much equity. And that's, I think, very true. But these two home price appreciation and equity interplay quite a bit, and that the tide can turn quite quickly. And there's some data from Black Knight that shows that what they call tappable home equity has gone down 15% in the last 2 quarters after a long rise up. And so that is starting to turn. Mortgage rates are a headwind. That's why I have it in red, with pretty much doubling over the last year. And this is a little bit outdated. This November number has come down to just over 6%. So that is helping a little bit, but still you have much higher mortgage rates than you did a year ago. And then average days delinquent, when we see that go up, that's a sign that we have distress that's been lingering and it's been delayed by pandemic triggered foreclosure prevention efforts, which have been in many ways very successful. But then you have these folks who the distress is just kind of sitting there and lingering, and those are going to be less likely to avoid foreclosure.
Daren, that's something that I really want to get your view on. I talk about this a lot. This isn't this pin-up inventory of delinquent notes that they've tried to do every effort under the sun to modify them and get them to pay and stuff. And we're down to about 1.8 million loans that aren't paying. And I'm not saying they're all seriously delinquent, but the average delinquent days on market, that's not normal. I mean, that's way abnormal, right?
Right. Yeah, it is. And I mean, during the last, if you look at this number back during 2008, 2009 period, it got up to as high as over 700 days. But the more normal is below that, closer to a year a number. So we're well above that. It's trending higher. And yes, the pent up inventory is certainly, that's more of that short term theme that I would want to talk about. Is there's this pent up inventory from the pandemic that's starting to come through right now. And at the same time, you have this recession brewing that's potentially, and home price correction brewing that's potentially going to cause another wave behind that short-term wave and a long-term wave. So, and I want to be careful about using the word wave because I don't know what that means to people, but it's a trigger word for some people. But we're not seeing anything necessarily as large as the 2008, 2009 at this point. But certainly there's more volume coming. This is just digging into that recession indicator, that yield curve indicator a little bit more, looking at the yield, the difference between the 10-year Treasury yield and the 3-month Treasury yield. And this has been the most reliable indicator of recession historically, going, if you look at this, going all the way back to 1960s. And we're now at the New York Federal Reserve uses this to create an actual percentage probability of a recession in the next 12 months. And right now for January 2024, so 12 months in advance, they are saying the probability of recession for January 2024 is 57%. That's the highest it's been since 1982. So strong indicator of recession there. Home prices, this is digging into that home price piece a little bit more. Rising mortgage rates have done exactly what, to be honest, the Fed intended them to do, or is wanting them to do, which is as they've raised the mortgage rates, you have your affordability here. This is the payment to income ratio has gone up, and it hit close to 35%. And that seems to be the ceiling. When it hit that close to 35% of income to buy a median price home, that's when you start to see your home price appreciation decelerating very quickly here on this path. And we're down now, as I mentioned, about 2% in December. That 1.6% based on ATTOM data, according to National Association of Realtors, it's at 2.3%. So, but very close there, 2% appreciation. So the market is quickly decelerating. Home sales are also falling. And
I talk about this a lot. Like, look at just look at really January of 22, right? We're talking about a year. And, the percentage of income was, call it 18%, somewhere about like that number. We're going from 18 to 35 in a year. And, you and I are fully aware that the West Coast market, as far as property values, have deteriorated pretty substantially compared to the rest of the country.
Yep.
And, I deal with real estate investors across the country all the time. And Daren, you may not believe this, but some people in the East think that they're just immune to anything like that happening to them. Right. And
the East, meaning like
I'm saying we call it Denver and West is kind of
okay.
a term that we've picked up. I don't know if you've used that term before, but I've heard others use it. And
for the Rockies.
Exactly. And so the reason that is true, I believe, is because of the slide that you just had.
This one.
It's how much of people's income are they willing to risk to own a home?
Yep. And it seems like that's people, buyers basically started pushing back when those rates hit 6 to 7%, which translated into a payment to income ratio of 35% or close to 35%. That seems to be the ceiling. I do think that now, I think we may see the market stabilize here, at least for the short term, as rates have kind of calmed down their rise. But still, the underlying fundamentals are that it's much more expensive to buy a home than it was a year ago, the same priced home. And of course, that's why prices are slowing down.
So, Daren, I don't know if you have this in your slide deck or not, but one of the things that I want to talk about is this action that Fannie and Freddie have said they're going to take about controlling more of the interest rates on notes.
I don't have that, but I would, that'd be interesting to talk about. I'd love to talk about that.
Let's do that.
Yeah. But this is actually kind of getting to your point about the regionality, the locality of the home price appreciation. And you do see more. This is Zillow's home forecast, and take it for what it is. I know not everybody puts a lot of stock in Zillow, but I think directionally they're right. And there's folks like Goldman Sachs who are a lot more bearish on home prices. But in November, which is the latest data from Zillow, they're predicting for November 2023, in 12 months, that 669 of the markets that they look at, which is it ends up being about 75% of the markets are going to see a home price decline over the next 12 months into November 2023. What stands out to me is the previous 2 months, they were around 300 markets that they were forecasting to decline, and now it's double that. And so the pendulum is swinging, and you do see a lot more green in the Southeast. Those markets may hold up better, at least according to Zillow, even in Florida. But still, you see a lot of red throughout, east of the Rockies, where they're forecasting home prices to decline. I mentioned, and of course, this is not gospel, but it's a forecast. But Goldman Sachs, for instance, when they look at their markets, 95% of their markets, they're forecasting to see a home price decline over the next year. So that's the way that we're headed. And again, this is more for a long-term impact into 24, 25. People who bought in late 21, 22 at the top of the market will quickly be underwater with these types of trends on their homes. And underwater doesn't necessarily mean that they are going to automatically stop making their payments, but combined with some kind of income shock, that could certainly head in that direction. So I don't know when is a good point to talk about the Fannie Freddie stuff, Eddie, but we could, if you would like to transition.
Let's do that.
Yeah.
Now this is kind of my deal maker position, right? And I've got some friends, Daren, as you know, that are fairly significant in, being in the loan origination world, and play at a pretty high level. I like to say they make $1 billion bets. And I've got some friends that I call along the way and say, hey, man, why are mortgage rates going down and the rest of the rates are going up? And they're like, well, it's just the bond market, right? You're got a hedge fund that's sitting there with a, dry cash, and they're trying to weigh out, do they buy these loans even at a little lower yield versus, just sit on the money uninvested. And, but they remind me that the trend lines do tend to run together. And so the answer is, you and I have seen the mortgage trading world. They were selling gigantic loan portfolios into the bond market at 108 a year ago, right? Then all of a sudden they're selling now at 101, or they're selling it, right at about par. Well, that's because they're writing the rates lower than the market is willing to essentially pay, that 105, 108 number, right? And I think, and it's my understanding that Fannie Mae, Freddie Mac has kind of stepped in and said, you can't write these lower rates because it puts us at risk, and that they have committed to step in at loan level pricing and make adjustments to that. Now you're the expert, and I'm just a guy that talks to a few smart guys like you and kind of gets these ideas. But doesn't that really mean that Fannie Mae, Freddie Mac is going to start having more influence on how these loans are priced?
Yeah, it seems like that. And to be honest, I think I would love to hear more from you on what you think the impact is, because I think you have more insight into that specific world than I do. But I mean, the overall theme that we see from Fannie, Freddie, and others is that they are stepping more into this world, and they have been for quite a while, and into the distressed world. And certainly one of the biggest top priorities for them is to they really want to avoid as many foreclosures as possible, which is a great and worthy goal. But I think there's a line there where it can backfire. So, but anyway, what do you think the implications of that are?
Well, the guys that I talk to say that you can kind of write it on the wall, that they're saying, and they're citing that they're going to do it more in the prime season, which will probably be starting in March, that you're going to start seeing their hand over the kind of the top of the lender, telling them that, you can't write rates that low. They're writing rates low because they're afraid of losing market share. They're losing money on the margin of reselling the loans. when you were selling a loan portfolio for $1 billion for 108 cents on the dollar, and now you're selling it for 101, you're pretty much cutting into the heart of your margin, right? And so I think what they're worried is that to create the stability that they need, that they're saying, no, we're going to have more of a hand in helping you price the interest rates on these loans. So I personally, Daren, from what I understand, and as I said, I'm not that guy that sits in that seat, but I've got friends that are, that kind of make those billion-dollar bets. This mortgage pricing at the situation at the moment, people are all fired up about it. I think it's a false leader.
Interesting. Yeah. It seems to me like it could, again, backfire from my limited knowledge of it and end up putting more risk back with Fannie and Freddie, which they tend to want to avoid, or they have tended to want to avoid. But they are getting pressure politically to make sure that there's not, unfortunately, the investors of the world, whether those are property investors or note investors, do tend to be cast as the villain, and so they don't want them somehow taking too much advantage of the situation. And so I think that's maybe what's driving this, if that makes sense.
Yeah, I think it is. I think it from my perspective, just an entrepreneur, right? You're a guy that you guys are at the heartbeat of the market, and you're at the heartbeat of, the agencies and stuff, and understanding that from my perspective, we have a pent-up inventory of loans that are seriously delinquent, much more than normal. That's what we basically have said. And they don't seem like they're going to cure. They don't. So we're going to move to a notice of default, and we're going to see naturally what's going to, I feel like, seemingly a pretty dramatic increase, because as you said, we're only 80% of what was normal before the virus.
Yeah. And I'm going to move ahead to a slide that I think ties into that, where we see what you're talking about in the data. This is data from Black Knight, and that, to be honest, Black Knight doesn't encompass the entire market, so the actual numbers could be higher than this. I mean, they have the majority of the market, but basically what this is trying to illustrate is that growing backlog of delinquencies. I call them unprotected delinquencies, because they've gone through the forbearance program, they have gone through loss mitigation, or they've never entered the forbearance program, and they're now delinquent. That's what these bars represent. And we're now at, this is their latest data is as of November as well. It's a little bit delayed. It's now over 500,000 of those in that category. And I would say that is a very specific category of loans that are highly susceptible to that notice of default that you're talking about. A lot of people, when they talk about the delinquency numbers, they're looking at the red line. They're looking at the overall delinquency, and they're saying seriously delinquent loans are coming down. They've actually have plateaued here in the last few months. But that's what they'll point to, and they'll look to and say things are okay. But if you look at this, this number, this is a cause for concern. It is a much smaller number, but it's still 500,000 loans and growing that are, I would say, unprotected and delinquent, and very likely, to your point, everything has been thrown at these loans to try to prevent foreclosure already.
Yep.
And they're now very highly likely to go to foreclosure. We still see a lot of caution on the part of the servicers to move forward with the foreclosure. The servicers are all, to be honest, very afraid of the CFPB and being somehow accused of improperly foreclosing on someone.
Yeah.
And so that's what's driving this increase is their hesitancy to move forward on the foreclosure.
It won't change the delinquency. The actions that they're taking the net effect of it won't change anything. They're simply kicking the can down the road.
Yeah, I would say with this 500,000 loans, that is absolutely true. These are the ones that are driving that increase in average days delinquent. And I don't know the exact number on these, but I would guess that these are more like well above that 500 days delinquent. They're getting into the 700, 800 days delinquent on these loans. And so there is less chance that they could avoid foreclosure. And I would argue there's definitely a point, and we've probably already crossed it, where it's hurting the market and even hurting these homeowners more to hold off on foreclosure rather than, and certainly hurting the neighborhoods where these properties are, to continue to let them languish in this kind of purgatory of delinquency.
I agree with that. I think more of these houses are vacant than people think is true.
Yeah. So we are starting to see this translate slowly into rising foreclosure starts. I mentioned that earlier. The 21,000 in January, that's up 75% from a year ago. Still at 80% of pre-pandemic levels. So there is more room to grow there, I think. But we've seen now 21 consecutive months of rising foreclosure starts. That's kind of the first, those notice of defaults being filed. That's the first signal that some of this backlog is now being pushed into foreclosure with these increases that we're seeing. And then if you look at regionally foreclosure starts, there are some areas where we're starting to, about a third of markets, 28% of markets, where we're starting to see foreclosure starts above pre-pandemic levels. And those are places like Houston, Phoenix, San Francisco, Detroit, Seattle. So where you see the orange here, that's above pre-pandemic levels or getting very close to pre-pandemic levels. So some of this logjam is definitely loosening up. We're seeing that in the data. Now, what's been slower to happen in the data, this is data directly from auction.com, is moving from that foreclosure start to the actual foreclosure auction. And that also has been rising, but a little bit more slowly, whereas foreclosure starts are at 80% of pre-pandemic levels. We see the actual completed foreclosure auctions at 48%. They've been hovering over the last couple of quarters about 50% of pre-pandemic levels. And so that's been slower to come back, but it is coming back. And the REOs, if it doesn't sell at the foreclosure auction, it goes back to the bank as an REO. Those are even slower, not surprisingly, at 39% of pre-pandemic levels. But I think between that foreclosure start and these completed foreclosure auctions, that is where some of the lenders are packaging these up and selling them off because they don't want to be the one foreclosing. They don't want to be the entity foreclosing. They want to offload that risk. And so that's part of the reason for this discrepancy between the 80% foreclosure start number and the 50% completed foreclosure auction number.
Yeah, I know in our shop, the level of NPL activity, most all of these loans we're buying have a foreclosure has already been initiated. Very seldom do we actually physically start foreclosure. It's already been done. And as you said, these are loans that are passing down that conveyor belt. They're moving out of the original lender's portfolio. They end up in bigger trades. And as you well know, then they reaggregate these loans and resell them, and not necessarily all of them, but they resell them in smaller groups, and that's kind of where we're at. I would say our activity level is on the NPL. What we're seeing is excessively higher than we were seeing it early last fall. So, it's interesting that when I'm looking into your data, it isn't a perfect reflection of what we're seeing, and I know that you're avoiding the word wave, but I don't have to be as politically correct as you do, I don't think. And so I'm saying to you that there's no way it can't be a wave. I mean, I know I'm not saying you're saying that. I'm saying
Right. You're saying that, yeah.
I'm saying to you that these loans that are excessively delinquent and they've done everything they can to try to get them to pay again, they're not going to cure until they get posted for foreclosure.
Right.
And that's, and I think you're right. I think I think that these delinquent borrowers would be way better off to read the situation and walk away with dignity and some equity than doing it the other way. But the market is going to do what the market's going to do. I'll agree with that.
Yeah. We got to listen to the market. But yeah, some of the buyers I talk to who buy off auction.com are one that I was talking to specifically recently. He made the point, which I think is good, that when you don't have the threat, when there's so many delays, these homeowners think it's going to be delayed forever, and they're not. That auction is never going to happen. And when you have that environment, they're not going to take action proactively, as you said, to avoid that foreclosure, because they don't they don't have the stick to go with the carrot approach. And so if there's no consequence for just staying in your home and not making your mortgage payment, then the rational person is going to stay in their home and not make their mortgage payment and continue to do that as long as they can. So I think that's a little bit of the situation we're getting into here. These are the numbers, by the way, by state. The green is where we're seeing foreclosure auction volume come back more. And so I just want to make the point here that it does vary by state. It has to do with state foreclosure laws and how aggressive the states have been in foreclosure prevention efforts. But the green is where you tend to see these numbers coming back more quickly. A couple I'd probably highlight with, a lot of people look at Colorado and say, what's going on in Colorado? They're at over pre-pandemic levels now, 126% of 2019 levels. I would just say the volume is very low there. And so I wouldn't put a lot of stock in that, but I do think it's an indication of some weakness in the Colorado market. States that are higher volume and are closer to pre-pandemic levels that I would point out are Oklahoma, believe it or not, 90%, but it's still a pretty high volume state. Indiana also in that bucket is a couple of places where we're seeing the volume return, and it's higher volume. And then I did want to, just looking forward, and this is, I think, kind of, Eddie, to what you had just said, is some of our early indicators just this year are telling us that we are seeing the tide or the wave or whatever you want to call it. It's not just leveling off. If you looked at just the end of 2022, you might think it's leveling off, but it's actually these numbers indicate that it's growing. When we look at the January numbers, I talked about we were at about 50% of pre-pandemic levels in completed foreclosure auctions, but when you look at scheduled foreclosure auctions in January, those are now at 59%. So that's growing of pre-pandemic levels.
Yeah. And
when you look at the last 2 years, all 3 months, and I'm looking at even at January or February and March, which obviously we're not all the way through February and March hasn't happened yet. But we're already seeing higher levels of scheduled foreclosure auctions for those months relative to pre-pandemic levels than we were for the previous 2 years. And the previous 2 years is the full month. So, in 2022, for the full month of February, we're at 31% of pre-pandemic levels. We're already halfway through February at 50% now. And the same holds true for March. March isn't even here yet. We're already seeing 45% of pre-pandemic levels scheduled compared to a year ago, 41%. So those are kind of leading indicators for us that this wave or tide is growing and is headed toward more volume coming down the pike as the lenders slowly but surely have jumped through all the hoops they think they need to jump through and are bringing these properties to foreclosure. So I did want to jump back. That's more of the short-term view of things. here's what we're seeing for 2023.
Right.
To your point about more of the long-term potential of even more volume, I think we want to look back at some of these early payment default rates and especially with FHA, which tends to be the most risky loan product out there right now. We're seeing early payment default rates start to rise. Actually, they are rising. If you look at these purchase loans, they spiked during the numbers spiked during the pandemic. They came back down, but then they've remained elevated above pre-pandemic levels, and they're rising here. The blue bar is a purchase early payment default rates on purchase loans, FHA loans, and those are up 46% year over year, and more than twice the pre-pandemic level. So that's more looking at what's coming down the pike. And the Black Knight did some really interesting, a really interesting dive into this EPD, early payment default spike. And they're finding that probably not surprisingly, a lot of these are related to 2022 purchases that are now, many of them have quickly gone underwater because of the slowing home price appreciation. And so they're showing there's 500,000 loans that were originated in 2022 that are now underwater, 1.5 million with limited equity, less than 10% equity, and 60% of those are, I misspoke there. That's the total volume, but 60% of those, the majority of those are related to mortgages originated in 2022. And so that's where you see this emerging risk, is people who bought near the top of the market with these low down payment loans like FHA and are now quickly all of a sudden underwater on these loans. And so that's where we see the risk emerging. It's concentrated, as I mentioned, in FHA, VA, which are the lower down payment loans. We're seeing the negative equity percentages rise on those very quickly. I mean, this number is 8% of all 2022 mortgages across the board are now marginally underwater, meaning less than 10% equity. But that number is for FHA and VA, that is 60%. Instead of 8%, it's 60%. So it's a much higher number, much higher risk with that limited equity. And I think that's where we're going to see potentially, especially if we have a recession and job loss, that combination is going to result in more of that bigger volume. And I'll move to our long range forecast, which is showing different scenarios. If we do have that recession and home price correction, we would see the numbers based on our models these are completed foreclosure auction numbers, looking more like this red line, which is getting back basically to 2015 levels over the next few years.
Yep.
So that's certainly a scenario that's out there. I mean, we put in this baseline scenario, which basically is a soft landing. So we said, okay, yeah, there is a chance that some of these economists out there who are saying, yeah, we're going to achieve a soft landing, that's a chance that's going to happen. And if that does happen, it's going to, the foreclosure volume will look a little bit more like just flatlining at below even 2019 levels. I think right now, these two scenarios are, I would lean more toward the recession and correction scenario being more likely at this point, which would result in closer to this volume than the lower volume.
You and I had this conversation the last time that we interviewed you, and you and I talked about, these models that you've built to project, different things. And I don't know, Daren, if you guys have a definition for this, or maybe it's just an Eddieism, but I think we are in a real estate recession that may not be in an economic recession.
Mm-hmm.
And so my question would be, is this because of a recession period, or could this red be true because of only a real estate recession?
Yeah, I think this red, the recession that we have built in here, it's not specifically tied to what part of the GDP is in recession, which I do think if you look at the GDP numbers, the residential real estate portion of, or not residential real estate, the real estate fixed investment portion of the GDP is in recession. It's seen big declines in GDP, that portion of the GDP. So by that definition, I would say we're in a real estate recession already. And some of the numbers that you see in home sales and home prices that I showed earlier are also evidence of that. I would say that this recession that we have here, it's not specifically tied to what part of the GDP is in recession, but it's a mild recession. It's saying unemployment goes to about 5%, which is not, to be honest, is not a huge recession.
Yeah.
But it's, so I would say it would track with the theory that only basically kind of the consumer part of the economy is actually staying strong, which we're seeing here. Consumer spending part of the economy is staying strong, but the real estate portion of the economy is in recession. That would be somewhat consistent with this red line. If we saw a deeper recession, then you'd see the line going up much further, to be honest. So we're saying unemployment still, even with this red line, is staying below 6% there, which is not a severe recession in terms of historical context.
Well, Joe's opener was the investor makes the best decisions with data. And so you continue to help us make decisions about the market. I'm not trying to call the market anything other than what it is. I mean, if there's a side of our business that becomes really active in non-performing notes, and there's a side of our business that's kind of negatively affected. So I just always want to make sure that I can listen to smart guys like you that have good information.
Yeah.
Because that's what helps us all as investors make decisions.
Yeah. And you know what, to be honest, I don't want to trust my gut either. I want to look at the market and the data, because for auction.com, it's a little bit of a double-edged sword. There's probably a lot of people assume that if there's a recession and we see this red line, that's better for us. And in many ways that's true, but there's actually some of our metrics that are worse off in that red line scenario. And so it's not all, it's not quite as black and white as you might imagine. Yeah. And one of the things I look at a lot now, and especially more recently, is our buyers are what we call our local community developers. These are the investors who are out there in hundreds of markets across the country buying properties off of auction.com. And their behavior, we have a lot of great data on how they're bidding on our site and how they're saving properties, how interested they are in properties, and how much they're willing to bid. This is the winning bid to seller value. That's actually turns out to be very predictive of what the market's going to look like in the next couple of months. When we track that bidder behavior in a model against home price appreciation, it's very predictive here, as you see on the left-hand side. And they basically predicted the slowdown. Our buyers started getting these lines all go down, basically.
Yeah.
They were bidding less. They were buying fewer properties. That's the sales rate. And their saves per property went down. They were shrinking their buy box. What I would say, and to be honest with the data, is that just in January and now even in February, we are seeing that line go back up. These lines go back up just a little bit. It's really a 1-month trend at this point.
Yeah.
But when I talked to one of our buyers recently, he said, yeah, this reflects my attitude. I'm cautiously bullish right now on the market. And this is specifically the housing market. So just, I mean, I wanted to throw this in here to let you know, I do try to follow the data, that a lot of the long-term trends are pointing to a non-soft landing in the market. But this short-term trend actually maybe is an emerging kind of green shoot that the market will achieve a soft landing. And our buyers are telling us, at least for early 2023, they're pretty confident. They're more confident, much more confident in the housing market than they were even 6 months ago. So that's one little silver lining for you there as well.
Well, I was with a guy last week that is a very sophisticated investor and is a top realtor in the Phoenix market. And he told me the same thing, that they had seen a trend back in January, and they had a pretty good slide before that happened. So I wonder if that's regional somewhat, the markets that have slid back, so much. I noticed your color chart changed pretty much depending on markets that have already had, a pretty good decline. So,
yeah. And this is kind of based on those same metrics I was just talking about, where our buyers are most confident or least confident about the market. And the red is they're hedging the most against a price correction, and it does tend to be coastal California is the red. Minneapolis is a little bit of an outlier. I'm not sure what's going on there. A couple markets in Florida they're really scared about. And the yellow is also, they're very cautious. So there's a lot of yellow. The main places where they tend to be, or at least our buyers tend to be still pretty bullish on the market, tend to be actually in kind of middle America here, Indiana, Illinois, which is a little bit surprising to me, but not Chicago, but more rural Illinois, a little bit more rural Indiana, and a few markets here in the Southeast. But that's what they're telling us now. I think certainly, and we're already seeing it in the data, coastal California is already experiencing a price correction. Austin, Texas, which I believe that market is already experiencing a price correction.
Well, some things change and some things don't change. And when we see those big blow up markets, then it becomes pretty predictable of what you can expect to happen in the future. And that is some of that appreciation is going to roll off, So I guess that's, if I'm looking at the data and following what you're saying, I think that's what that map kind of shows that. So
yeah,
Daren, great stuff.
Yes. Thank you, Eddie, for the opportunity and great questions as always, and insights into the data.
Well, the thing I love about it, and I so appreciate your coming on here and doing it. These guys get to hear our position all the time. And we try to work at it. We try to be a little better operating with data than a lot of educational companies, because as I said, I think it's the only way you make really the right decisions. And but I listen to you and think you're the guy that's into it every day, and I just always think you definitely help form the direction that Joe and I are going. Joe, you ought to come on here and make sure I've not missed something, asking Daren something really important.
No, Daren, you nailed it. And, this is what we see happening, on a weekly basis as we're looking and pulling the data that we use to make decisions. And we want everybody that watches us and listens to what we say to have the best information available. And if you do that, this market becomes, wow, this is an okay market. If we know what's going on, we can make the best decisions versus, oh crap, I don't know what to do in this market, right?
Right. And you want to avoid the oh crap reaction and go toward the I'm ready for this.
Right.
Well, I think that's the case, and so I've really you haven't surprised me today, but you've certainly given me some direction that is a little different than maybe I was thinking, and I suspect for our entire audience. I'm hoping that you'll be kind enough to share those slides with us, and we'll put them in the show notes, and so forth, because they're just
Absolutely.
they're beautiful. They're so well prepared. I know how much work that takes. Joe and I do, and we applaud you and just thank you so much for sharing it with
Well,
us.
and I love the highlighter feature. I don't really use that very much, but you reminded me about that, and it was great to hopefully highlight some of the key things on these slides that I'm looking at. But man, yeah, at the end of the day, to me, it's not trusting your gut. It's looking at the data, and for us specifically, this buyer data that we have is so rich because it's comprised of thousands of local folks who know their markets the best and are operating in those markets, and they're telling us in how they're bidding on auction.com, what those markets are going to look like. And I find that very informative, and it allows me not to just base things on the way I want things to look.
Exactly.
It's very enlightening to know that you can hit the target based on local circumstances, just other than just, hey, kind of pick a number, right? So
that's right.
Daren, we really appreciate you being on with us. I can't believe it's been a year since we did this last time.
Has it really? Wow. Okay. Yeah.
Daren, you're awesome.
Go back and see if my predictions come true.
You know what? I tell you exactly what you said last year is about exactly what happened.
Yeah.
So you were pretty dang accurate before, and I've watched you for a long time, and so I think your data makes it not a surprise.
Yeah.
Right? It's just watching a trend.
Yeah. And especially if you stay on top of the data, you're not just saying, okay, here's what things are going to look like this year and then go away and never come back and look at it, because things can change. So it's good to keep maybe every couple months or 3 or 4 months at least, looking at the data and saying, has there been a major shift? So,
well, Daren, it's like, you ask people if they like surprises, and it can go either way, right?
Daren, you're awesome. Thank you so much for your time, your valuable time, and your wonderful information. Thank you very much.
Yeah, absolutely.
Thank you, Eddie. Thank you, Joe.
Yes, sir. And guys, again, we'll get Daren's slides in the notes there for you. And again, another great episode of Note School TV. And remember, our motto here at Note School is we show you how to close more deals and have the best information, the best data that you can have to make the best decisions. We will see you same time, same place next Wednesday at 11:05 Central Time. Have a great week.